Good evening, everyone. Samarkand Global, Samarkand Group PLC, as we are now. We started the business back in the end of 2016. My business partner and I spent some time in China with a friend of ours who is a pioneer, really, in the cross-border e-commerce market in China, having launched a very successful Australian healthcare brand into the market. What he saw was that there was a lot of demand and interest for European brands, but the European companies tended to struggle with Chinese e-commerce a bit more than their Asian counterparts, in part to the business culture, the language, but also the incumbent model of needing to find a local distributor, sign over a large part of your margin and effective control of your brand for sometimes 3 or 5 years on an exclusive basis. It was quite a tricky problem to solve for a lot of brands. So we came back to the UK with the idea that we would provide a way for brands, international brands, to sell to Chinese consumers in just as easy as they can from their own website. We've now got 2 offices, one in London, one in Shanghai, about 100 employees, split almost equally between the 2 locations. We have also 2 distribution centres, one in South London and a third-party operated one in the Shanghai Free Trade Zone. We have triple-digit revenue growth, and we operate a number of different e-commerce storefronts and solutions for our brand partners, and we do it all through our proprietary technology platform that we call Nomad. We recently listed onto the Aquis growth market in March, so just over a month ago. We targeted a raise of £10 million. We were more than twice oversubscribed, so we've actually taken 17 million at the IPO. Very good split between private and institutional investors. It was cornerstoned by Schroders, who came in with £5 million. We've got a very good roster of other institutions as well. We had a £1 million also from Invenfin, which is the growth capital division of Remgrow. And actually, hot off the press, yesterday we announced a further £3.1 million investment from a company called SF Express, which is China's #1 delivery company. They are a very well-known brand amongst Chinese consumers shopping online. Chances are SF Express will have delivered their parcel. We've been working with them commercially for a couple of years now. So having them as an investor now is a great step forward and validation of our technology and our approach. And also our high level of employee ownership as well. 15% of the company owned by employees going into the IPO, and nobody cashed out at the IPO either. Employees, previous shareholders, etc. Sorry, excuse me. Our board is a very experienced and relevant board of non-executive directors. Jeanette Hearn is the chief financial officer for Smollen, who are a shareholder of ours for a fair while now. Smollen, one of the world's largest retail service companies. They employ about 80,000 people in 60 different countries, work with most of the world's large consumer goods brands. Jeanette Hearn Tanith Dodge is our non-executive chairperson, former group HR director for M&S, from Business Village. She's on the board of Robert Walters and on the advisory council of PwC. And Keith Higgins, almost 20 years of e-commerce experience with 2 of the world's largest consumer goods brands. 2003 to 2010 was the e-commerce director at Procter & Gamble, moved to Unilever as the executive vice president of e-commerce there, where he headed up their global e-commerce strategy, and is now the chief customer development officer at Unilever. Myself and Simon, we've been business partners now for almost 13 years. Our previous businesses, digital marketing and gaming technology business, which we combined with a third business to create a company called Gaming Realms, which is listed on the AIM market. So China as a market is very large, lots of big numbers to throw around, but I think one of the more interesting ones is the fact that this year the majority of retail transactions are actually expected to occur online in China, so 52%, which I think goes to show the level of the digital economy in China. In terms of size, you add the next 10 markets together, you don't get the same as the Chinese e-commerce market. But it is a very, although it's a large one, it is a very complicated, especially for Western brands. And so what we've built is a technology platform and a range of managed services that kind of encapsulates all the costs, all the complexities that brands will face entering the market, and allows us to deliver a range of solutions for them. The platform itself is integrated into the necessary touch points for e-commerce in China. In the West, we have Amazon, and you sell from your own website, but in China, there is a lot more different platforms. The dominant ones are Alibaba's Tmall and Taobao, others such as JD and Little Red Book. We are integrated across a number of those. Payments as well. So Chinese consumers don't use Visa or MasterCard or American Express. They have their own payments ecosystem. So again, we're integrated with those. Parcel delivery, important consideration for any consumer shopping online, the fact that it will be delivered on time and reliably. DPD, UPS, Western providers are not as well known in China as the local equivalents such as SF Express or STO Express, and we're integrated with many of those. And as I mentioned, SF Express is now a shareholder of ours. Social media in China is similar kind of techniques and trends, but the technology is totally different. There's no Facebook, Instagram, Twitter, they're all blocked. So local equivalents such as Weibo, WeChat, Douyin instead. And our integrations with those allow us to give Western brands a kind of the same kind of view that they will see or expect from Chinese social media as they would expect for Western social media. And then finally, customs and regulation to take advantage of the cross-border e-commerce benefits, such as improved tax rates and faster delivery. You need complex integrations with China customs, central customs, corporate structure, all of which we have in place. And from that platform, we essentially offer three different solutions to our brand partners. First is what we call Nomad Storefront, which is where we build and operate e-commerce stores on behalf of our brand partners on the dominant platforms in China, such as Tmall or Little Red Book. And the way it works is when a consumer places an order on one of these platforms, it flows into our system. We can fulfill it from either our UK warehouse, a bonded warehouse in Shanghai, or if it's an Alibaba platform, then it's fulfilled from an Alibaba warehouse in China. And this is great for brands that have a appetite and a budget that allow them to have their own branded store. For brands that aren't quite at that stage yet, we have a second solution, which is called Nomad Distribution, which is really leveraging the power of social commerce in China, which has exploded over the last couple of years. So 2018, about 190 billion US dollars associated with social commerce. Last year, that increased to 560 billion. So that is where you have celebrities, key opinion leaders, influencers selling quite directly, quite overtly to their fans and followers who are there to be sold to be educated about products, to get product recommendations. It's been driven a lot by the popularity of apps such as WeChat or Douyin or TikTok, as we call it in the past in the West. And the way it works is an influencer like this lady in the video can take our products, put them into her live streams, into her feeds, into her social media posts, and then the fans and followers can purchase them directly. And through our integration with these platforms, the orders flow into our system, and then we can fulfill them from either the UK or from our bonded warehouse in China. And then third solution that we're rolling out now, which is designed for the brands that perhaps aren't yet ready for a presence directly in China, but they want to start to test the market. They want to convert traffic from Chinese consumers that come into their site. It's a low friction, low cost option. It's a software as a service plugin for niche brands. There's also an enterprise version for e-commerce sites that have existing large amounts of Chinese consumers shopping on their sites. The advantage for a Chinese consumer to shop on a brand's overseas website is that there's many better prices, a wider range, and importantly for a Chinese consumer, the fact that it's a guaranteed authentic product. But the barriers to that are quite high. The first being that the sites don't work very well for Chinese consumers. Facebook, Twitter, Instagram, Google, they're all blocked, whereas most Western websites are built with these technologies and sites integrated into them for tracking and marketing. So as the site's loading, it's getting blocked and it's running very slowly or sometimes doesn't load at all. So that's the first hurdle. If they manage to get past that, they get to the checkout and then they are presented with a Western range of payment options, MasterCard, Visa, American Express, which aren't used by Chinese consumers. So they can't actually pay if they get there. The third block is on logistics. DHL, DPD, UPS, not familiar to Chinese consumers in the same way that SF Express are. So their third hurdle is guaranteed and reliable delivery. And if you are sending to China through the mail currently, there's a fairly high chance that your parcel will get stopped at customs and assessed for duty. Between 10 and 20% parcels are, and that can cause an additional headache for the consumer who has to then pay the 20% duty to have the parcel released. So as a result, it's a not a great experience for a Chinese consumer at the moment. So Nomad Checkout is a single piece of technology that solves all of those problems. As the site is loading, we're detecting those scripts and stopping them from being blocked, so that when the site is loaded, it's within sort of 6 seconds with our technology enabled versus 52 seconds without our technology enabled. So the first hurdle is cleared, the consumer can now actually shop on the website. The second, they're then presented with information that their parcel will be delivered by the #1 delivery company, and they can pay using their preferred Chinese payment methods, either Alipay or WeChat Pay. So when they get to the checkout, they'll see a checkout for China button. This takes them through our Chinese optimized payment flow, which includes taking their name and address and all that relevant information in Chinese that's required. They get a breakdown of the costs and the shipping. And then they're able to pay using their preferred Chinese payment method, either Alipay or WeChat Pay. They're then sent their tracking information from SF Express, which allows them to track the parcel from the merchant through to delivery. And we send them a order confirmation and a order history as well. What's happening behind the scenes is that through our integrations with Chinese customs, the parcel is being pre-registered before it arrives at the port. So when it arrives, it has had all the duties paid, and it goes through the expedited customs clearance route. This is deployed with for enterprise client, and the improvements have been from 15 days delivery down to around 8 days, and custom stoppage rates from 15% down to less than 1%. So it gives a much better experience for the consumer. And then from the merchant's point of view, it's very easy for them to install. We have a plugin for Shopify. There's additional plugins being developed for WooCommerce and Magento. A few lines of code to install the plugin. If they want to enable the site speed optimization, it is a configuration change, no code change. And then from a workflow point of view, there's also no change. The orders come through into their Shopify back office. They pick, pack as they normally would, and then they send to a SMK consolidation point where we scan them in and overlabel with the end consumer's shipping label from SF Express and consolidate that with all the other parcels that we're sending. The other pain point that brands will have faced if they've entered the Chinese market is often the availability of data, and that can be a real challenge for a lot of brands. With our analytics solution, we are able to provide full transparency and visibility of where their products are being sold, for how much, on what channels, the customer demographics, if they have stock with us in multiple locations, where that stock is and the real-time stock levels. And then through our integrations with Chinese social media, we're able to start to give the brands the same kind of visibility on their social media presence and following, and how that's affecting their sales as well. From a finance point of view, the numbers that went out to the IPO with, we went out with 8 months audited numbers from April to November. Historically, prior to the IPO, we had net investment of about £3.3 million. From that, we generated close to £30 million of revenue and £14 million of gross profit. So we've been able to develop the business quite organically. Revenue-wise, we increased from 3.8 million for 8 months in November 2019 to 16 million for the same period the following year. There was 5.8 million in there of exceptional revenue, so like for like it is 3.8 million increase to 10.2, so about 166% growth, and at the same time improving gross margin from 35% to 57% as well. One of the other things that we see with everything we're doing in China is the opportunity to take low or no growth Western brands combined with the market intel that we have and the data and the sales channels and really accelerate the growth of those brands through what we do. Our first case study was a digestive health brand called Probio 7. We acquired that at the end of 2017. It gave it a bit of a facelift and some rebrand. Launched it into China in 2019, and sales over that 18 months were more than that brand had done since the late 90s that it had been in UK retail. So there's a very strong growth story we can do with brands like that. Last week we acquired a complementary brand called Z2S Products, which is designed for fertility and support of IVF and assisted reproductive therapy, which China is now the biggest consumer of. So there's a big potential that we see for those kind of products within our system. Just in summary, we have triple-digit revenue growth, improving gross margins. We have strong institutional, strategic, and employee shareholder base. We are well established in the UK and China. We have experienced and relevant board of non-executive directors, strategic partnerships with industry leaders. We operate in one of the fastest growing industries, and we're well placed to benefit from the macro trends and changes that are taking place. Merchants need to find new markets outside of the UK as a result of Brexit, for example, the rapid shift towards e-commerce as a result of COVID. I think that's the presentation done, and I've got some time for questions.
Starting off, you raised 17 million on IPO. What's the money for?
So the money is going to be used for, so I'm just getting you up on the screen here. So the money is going to be used for further development of our Nomad technology platform, expansion into other markets. So we're quite UK focused at the moment, but we are expanding into other markets, initially continental Europe and Northeast Asia, so Japan, South Korea. There's a big demand for those kind of products from Chinese consumers, and we see actually similar demand for the technology solutions that we've built for Western Europe in those markets as well. So that's the other area. And then the other is strategic acquisitions as well.
The investment from the Chinese delivery company, SF Express, does that come with it any constraints or requirements for you to use them as a provider in China, or are you still able to use other delivery companies?
We're still able to use other delivery companies where they are comparable in coverage and price. We would use them, but we're not bound by any need to use them for anything. So we're free to use other providers, and we do in some occasions, but they are the number one. So they have the coverage that we need, and we're already working with them on business development opportunities in a number of different markets as well. So we definitely have a particularly close relationship with them, I would say.
And just for those who aren't familiar, the Aquis exchange been asked about. Aquis used to be called the Next exchange, and before that, Plus Markets. The question is why you chose to float on Aquis rather than AIM or the main market?
Yeah, we chose Aquis because when we were evaluating the options, it was AIM or Aquis. We really liked what the Aquis team were doing with the exchange, their approach. It's quite a disruptive approach, and I think we're philosophically quite a disruptive business as well to what we're attempting. So that was one area. The other was that when we did the pre-marketing for the IPO and Aquis was talked about, it was very positively received by the institutions as well. And the ability for private investors to come in on the IPO was possible as well. We did a growth prospectus, so it was well received all round, and it's been a good experience as well, having gone onto that market. Volumes have been.
Just to note, if you're an AJ You Invest customer, we recently added the ability to invest in Aquis listed companies via your AJ Bell account online and over the phone, I think. So those companies are now tradable or investable via AJ Bell, I think, and some of the other platforms as well have also, I should mention, done the same.
That's right. Yeah, that was part of the decision. Is we felt that they were putting in place a lot of the interesting developments like integration with AJ Bell and other platforms, and we were kind of be at the front of the queue, I guess, I suppose you could say.
Question about number of transactions per month. Are you able to say how many transactions you're fulfilling a month?
Yeah, I don't think it's. I mean, I could talk about probably historically. It ranges. There's Chinese e-commerce shopping cycle is quite. There's seasonality to it. So a kind of standard month, it would be 10 to 15,000 parcels. During peak times, it could be double or triple that. The big shopping festivals are around June and November, which is when things really kind of increase. We have mentioned we have a warehouse in the UK, which is our own. We fulfill from there, but we also have a secondary warehouse in the Shanghai Free Trade Zone. So the way we work it is we put stock into both. With the lines that are moving fast, we have there, and then we're also constantly filling into Alibaba warehouses for Tmall stores, for example. So we have quite a well-developed logistics function.
Would you need similar warehouse or capacity in continental Europe or other Asian markets if those are territories you expand into?
So all of our software it's all cloud-based. So a third-party provider can use our software, or we can do a direct integration. So, for example, in the warehouse in Shanghai, that's not our warehouse. We've just done an integration into their system so that they can fulfill it from there. So we don't have the big CapEx requirement of opening warehouses wherever we go. We can use third-party providers quite easily. It may be as the scale increases in continental Europe, we would want to open our own. There is some advantages to do that, but as a first step, we don't have to have that big kind of CapEx.
And a question on the brands and your ownership of them. So it explains you bought 2 brands.
Yeah, that's right.
And so the strategy of buying brands and owning them versus fulfillment for other companies, where else would you acquire the particular niches or targets that you think would be right for you?
So health is a very strong category for cross-border e-commerce in China, well, globally now as well. So we see a particular niche there for us. The other is beauty, and skincare is another strong category in China particularly. So those would be the 2 main areas where we would look to do further acquisitions. It's a question that's come up on a number of occasions. Technology versus brand. I think I guess the best example of a company doing that successfully is probably the Hut Group. Recently, they have a very good technology platform, and they also own a lot of brands. We have a similar model in that respect to acquiring the brands that we can see have potential, and then really sort of turbocharging them on our sales channels and platforms.
And final question for me then, can you do the reverse? Would you have Chinese consumers selling to the UK?
So there is a lot of Chinese companies selling on Amazon and on those sites. It's not something we've got involved with, to be honest, yet. we've got a lot on our plate going the other way, and what we're trying to do in that respect. So it's not a focus for us.